Market psychology refers to the collective sentiment, emotions, biases, and cognitive biases that influence the behavior and decision-making of investors and market participants in financial markets. It plays a significant role in shaping market dynamics, driving asset prices, and influencing market trends, cycles, and volatility. Now, let's dive into a detailed explanation of market psychology. Let's explore some key concepts. Herd mentality, or crowd psychology, describes the tendency of individuals to follow the actions and behaviors of the crowd without independent thought or analysis. This leads to groupthink, momentum trading, and amplification of market trends. Fear and greed are primary emotions that drive market psychology. Fear of loss, or loss aversion, motivates investors to sell assets during market downturns, while greed, or the fear of missing out, fuels buying pressure and speculative behavior during market rallies. Risk perception varies among investors and can be influenced by cognitive biases such as overconfidence, anchoring, confirmation bias, availability bias, and recency bias, which distort judgment and decision-making. Behavioral finance combines principles from psychology and economics to study how psychological factors and irrational behavior impact financial markets, challenging the traditional assumption of rationality in economic theory. Let's discuss market phases and sentiment. In bull markets, positive sentiment prevails, characterized by optimism, confidence, and exuberance among investors. Greed drives buying pressure, leading to rising asset prices, low volatility, and widespread risk-taking behavior. Conversely, bear markets are marked by negative sentiment, fear, and pessimism, as investors anticipate further losses and seek to limit their exposure to risk. Fear drives selling pressure, leading to declining asset prices, increased volatility, and risk aversion. Economic indicators. Market sentiment can be influenced by economic indicators, such as GDP growth, employment data, inflation rates, consumer confidence, and business sentiment surveys, which provide insights into the health of the economy and future market prospects. Corporate earnings. Earnings reports and corporate announcements can impact market sentiment by signaling the financial health, growth prospects, and management outlook of companies, affecting investor confidence and valuation multiples. Geopolitical events. Geopolitical tensions, conflicts, trade disputes, and geopolitical events, such as elections, wars, natural disasters, can create uncertainty and volatility in financial markets, influencing investor sentiment and risk perception. Central bank actions. Monetary policy decisions, interest rate changes, quantitative easing measures, and forward guidance from central banks can impact market sentiment by affecting borrowing costs, liquidity conditions, and investor expectations for future economic growth and inflation. Sentiment analysis. Monitoring market sentiment indicators, sentiment surveys, investor sentiment indices, and social media sentiment can provide insights into prevailing market sentiment and potential market trends, helping investors make informed decisions. Contrarian investing. Contrarian investors seek to capitalize on market psychology by taking positions opposite to prevailing sentiment, buying assets during periods of pessimism or bearish sentiment, and selling during periods of optimism or bullish sentiment. Risk management. Understanding market psychology is essential for effective risk management, as investor sentiment can drive market volatility, amplify market trends, and increase the likelihood of herding behavior, speculative bubbles, and market corrections.